All right, one bank says a bounce back is not on the horizon for the markets, at least not this year. Bank of America slashed its S&P 500 target to the lowest on Wall Street at 3,600. The bank is citing recession forecasts and a possible Fed pivot as the reasoning for the drop. Joining us to discuss this 900-point cut is Bank of America Senior U.S. equity strategist Jill Carey Hall. Jill, happy Friday to you. What prompted you to make this call right now?
So we've been more cautious than many of the strategists on the street. Going into the year, we were looking for a down year in equities. So we did reduce our S&P 500 target to 3,600 for year end. That is several percentage points below where we're trading right now. But it's not as bad as the typical decline that you would see in the market during your average recession. So we at B of A are expecting that we're going to be entering into a mild recession starting around right now, and that we could have 5 quarters of negative sequential GDP growth through early next year. But this recession we would expect, given the lack of excesses in the economy, to be a milder one than many of the recessions historically. So we do expect that the decline in the market wouldn't be as detrimental as some of those that we've seen. We do expect it'll be a volatile backdrop, and this backdrop will be about picking your spots within the market, looking for higher quality stocks, lower risk stocks that have healthy free cash flow. Those are the areas that we think are, well positioned to hold up within the market.
Jill, 5 sequential quarters of negative growth, that's pretty significant. I'm not hearing that out of a lot of other Wall Street firms. What's your maximum downside risk for the S&P 500 if that does come true?
So our base case is that, these 5 sequential quarters of negative GDP growth, the peak to trough decline in GDP is going to be around 1.5%, which is similar to the recession in the early 90s. So one of the milder ones by historical standards. So, we do think that the S&P 500 ends the year at 3,600. Our sort of max, downside case scenario has been 3,000 to 3,200 on the S&P, which would be more consistent with the typical, a little bit over 30% peak to trough move that you usually see within the market as a downside case.
Hey, Jill, it's Julie here. So I guess tonally, what you're saying and kind of the attitude of this downgrade to your target is not different from many others that we've been hearing. So I guess I'm trying to figure out what exactly is different. It sounds like perhaps the duration that you guys are predicting for this recession is a bit different. What else do you think that you're seeing that some of your peers on the street are not? To be clear here, this is the lowest target of the strategist on the street at 3,600.
Yeah, I think, the consensus, economic outlook hasn't necessarily been forecasting recession yet. But at B of A, we have felt that, at this point, we're likely entering into a recession now. Again, we do think it will be milder by historical standards. And the upside case is that we have a soft landing. We do track a number of other indicators. And obviously, all recessions are different. Definitions of recessions are different. We track a regime indicator to attempt to figure out where we are in the cycle based on a number of different macro data inputs. That indicator has still been suggesting we're more of in a late cycle backdrop. So again, I think, the upside risk here is that we do have more of a soft landing. I think what else is different is, based on the backdrop that we're in. So I head up small and mid cap strategy at B of A. And we do think that, even though we're forecasting downside to equities, that within the market, a better place to be is small caps than large caps. And so, that's not typically small caps underperform in a recession, which they have so far, but they've actually already been pricing in the recession risk in our view. The decline that we've seen in small caps has been much more comparable to even some of the worst recessions that we've seen. Valuation multiples have come down to prior crisis lows. So So we actually think that, based on what's been priced into the equity market at this point, you could see less downside risk from here for smaller stocks than for larger stocks. And I think the nature of this economic backdrop, we found it to, in our view, be a more supportive environment for domestic U.S. small caps, given a lot of the trends we're seeing, higher inflation. Small caps actually outperformed for, during the 1970s, the early 80s, inflationary regimes. And, these stocks are more domestic, given all of the geopolitical risks. We're also, given the coming earnings season, going to be watching corporate commentary closely, because what we've been noticing is that even though management's commentary has been growing weaker and corporates have started to guide down more within the S&P 500, for small caps, guidance has actually been improving in recent months and is much more positive than it's been typically leading into a recession. So we'll be watching that closely. But right now, we do see small caps as better positioned than larger stocks.
And are there particular areas, subsectors, for example, within small caps that are attractive to you, or are you more looking at them broadly as an asset class?
Well, both. So I think overall, we do think on a relative basis, they look more attractive than large caps. But, certainly there's been a really big focus on quality within the market. And there's a lot of ways to define quality. We could think about earnings stability, stocks and sectors and that have more stable earnings. You could also just look at, companies that are profitable versus non-profitable. And one of the reasons the Russell 2000 small cap index has underperformed so substantially is that, about a third of the index is stocks that are non-earners, stocks that, don't have profits currently. A lot of that has been within, healthcare, biotech. So that's a sector where, within large caps is a defensive sector we've been more favorable on. Whereas within small caps, we do think that sector still looks riskier, given how many stocks are still lower quality, don't have earnings. The S&P 600 small cap index, in contrast, you've seen a really big divergence there in how these two small cap indices have performed. The S&P 600 is a much higher quality index. So, much fewer stocks in that index are non-profitable. And that small cap index has actually been outperforming the large cap indices year to date. So, we would advise focusing on quality, across the board within both small and large caps. Focusing on stocks with healthy free cash flow, which tends to be rewarded in this backdrop. Focusing on dividends. I mean, we're in a total return world. Dividends are, going to matter more than they have been when we were in a backdrop of price returns that were much more elevated. And we do think that, companies that are, able to sustain and raise dividends will be rewarded. And we have seen a reward for companies that have been paying healthy dividends within both small and large caps for much of the last year.
Yeah, and Jill, that's a really good point between the S&P small cap and the Russell 2000, a differentiation that we don't always hear a lot about. Jill Carey Hall, good to see you. Bank of America Senior U.S.
Thanks.
Equity Strategist. Thank you.